Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Oh my, everybody. It is Friday of Super Bowl weekend. Good afternoon, 7 investors, and welcome to the Friday edition of 7 Investing Now. My name, of course, is Daniel Brooks Klein. I'm the host of the program. I'm joined today by Matt Cochran and Steve Symington. Matt, are you rooting for Tampa Tom? We're both Florida guys. I'm a New England guy. I'm pushing for Tom Brady.
You know, I am pushing for Tom Brady, but it's more because as a lifelong Miami Dolphins fan, I feel like if Tom Brady wins, it really rubs New England's face in it a little bit more. So I'm going for Tom Brady, and that's that.
He won me 6 Super Bowls. I don't care if he plays for like the Empire in Star Wars. I'm rooting for the guy. Like there's pretty much no heel turn he could make, and he's tried. He's tested our patience. Steve, are you pulling for Kansas City? Last year,
I'm mostly indifferent, but I'll root for the Chiefs this time just for kicks. And I'm a Dolphins fan too, so for what it's worth.
That's very strange. Is that the closest team to Montana? Like, I'm not sure how that
works. No. My boy's rooting for the Chiefs, and he's a Seahawks guy too, but they're obviously not there.
So last year at this time, I watched the Super Bowl on a cruise ship on the Navigator of the Seas, and it was awesome because like everyone was like super social. But I realized while I was watching it that they were showing the international feed of the game because like the commercials were none of the commercials I was reading about. It was like, you know, all strange like European cars and chocolates and whatnot. So I had to do a podcast the day I got home on Tuesday. I had to watch the Super Bowl again just so I could see the commercials, which is a very strange experience. But we're going to be talking our top story today. Oh, and Sam, do you want to share our new graphic? We have a cool, fancy new graphic that shows what we're going to do on the show. I'm hoping Sam Bailey has that ready. If she does not, we will debut the new graphic on Monday. we have prepared. It's a really cool graphic. It shows what's going to happen, but it got finished right before the show. So my apologies to Sam if I didn't make that clear. But our top story today is, should big tech be worried about antitrust enforcement? So we have a Democratic president. I almost said governor, not sure why. We have a democratically controlled Congress by a razor-thin margin, and Senator Amy Klobuchar, a candidate for president, a lot of people thought was going to be the vice president. She's unveiled a massive antitrust reform bill. This is aimed at Facebook, Amazon, Google. Steve, what's going on here? What is she trying to do?
Well, we sort of knew that increased antitrust scrutiny was a risk facing some of these massive tech conglomerates with the incoming administration in particular. And so yesterday we saw reports that her legislation would essentially block companies from making acquisitions until they can prove that those purchases won't create an appreciable risk of materially lessening competition. And by comparison, right now, the onus is on the government to prove that very thing if they object, basically by objecting to an acquisition. And we have to keep in mind, I think, that this isn't a given. It's going to get some pushback from not only the big tech titans who have some deep pockets and some decent lawyers on their side, but also from Republicans who have previously objected to similar ideas when they were brought up in Congress. And, not to mention resistance. There's going to be a lot of resistance, I guess. That's how I'll put it. And not a given yet, but definitely a risk for antitrust legislation, and something to watch for investors going forward.
We'll come to Matt in a second to talk about what's actually in the bill. I'm going to push back a little bit because I think in this day and age, when anybody can start in anything, it's really hard to prove monopoly. So the one I'll give as an example is, how long was T-Mobile Sprint delayed? T-Mobile and Sprint had to combine. Sprint was going to go out of business, and T-Mobile would very slowly get to where Sprint was. But if you look at the technology, every cable company could be a mobile phone carrier if they wanted to be. So right now, it's not going to be profitable quickly, but if you and I wanted to start a Google competitor, we could do it with $80. It would take a long way to get there, but the world is so democratized in terms of technology. There's not this big barrier. But Matt, what's actually in the bill? What are some of the provisions and changes we're looking at here?
All right. Yeah. So Klobuchar's bill. Did I say that right? Klobuchar?
You did.
All right. Good. It's going to seek to strengthen antitrust enforcement in the following ways. So first, it raises the bar for quote unquote dominant firms seeking to merge with other companies. And it's almost now like companies are guilty until proven innocent now. They have to prove the merger is not harmful to competition rather than the governing bodies proving it is. So the burden of proof would shift if this bill is passed. It adds a prohibition on the exclusionary conduct to the Clayton Act, which I think that's pretty common sense. Everybody knows what that means.
Steve and I were just talking about the Clayton Act. That's Mark Clayton from the Dolphins all those years ago.
Obviously,
my kids were asking me about it this morning.
So yeah, exactly. My kid explained it to me this morning. It makes it harder for dominant firms to prove their mergers won't harm competition when they engage in such acts. So this would include acts that disadvantage current or potential competitors or limit rivals' ability or incentive to compete. Do I think that's vague? Yeah, I do. I think that's very vague. It allows antitrust enforcers to seek civil penalties for violations of monopoly law. That actually, I like that provision. It creates an independent office of the competition advocate within the FTC that can conduct market analysis to inform enforcement and help elevate consumer complaints. And it requires merged companies to update agencies on the outcomes of their deals. And it extends whistleblower protections and incentives when they flag potential violations.
So again, I'm going to be very skeptical here because this is targeting Facebook. This is targeting Amazon. But when you look at Amazon competes with Walmart and Target, not a monopoly. Like you look at AWS, they compete with Microsoft and Google and IBM and not a monopoly. So sure, if Heinz buys Hunt's, you have a ketchup monopoly but who is that hurting? I'm not really sure why these rules exist. And the really only monopolies I can point to that have been consumer damaging was cable companies having exclusive territories, but even that was for a reason. They paid the money to lay out all the cable, so they needed communities to say, hey, for 20 years, you can be our cable provider. Steve, do you think this leads to any breakups? Is Facebook going to have to sell Instagram?
No, I don't think that's what happens. I think, it immediately what comes to mind is that those hearings last year with Zuckerberg, where when he was testifying in front of Congress, and it felt like a 14-year-old explaining their Xbox to their grandma. It's like,
how does Facebook make money?
Yeah, or why is an advertisement, or why is an ad showing up that talks badly about me on my daughter's iPhone to Google's CEO, and he's like, we don't make the iPhone, but so there was lots of stuff like that, and they asked Zuckerberg's point blank, do you have a monopoly? And he said, it sure doesn't feel like it. And who are your competitors? And it became painfully evident that they didn't understand how the world of big tech works. And yes, they feel dominant, but they have significant competition, and it's continuous innovation that they're working to kind of stay on top. But it's this battle of technology, and I think they'll be able to make pretty decent cases that it won't harm competition. But it's just, you see the rise of companies like TikTok, for example, which it's not, it comes out of nowhere. And that's how these big, huge, wildly popular apps and sites and social media platforms rise. And TikTok's a Chinese company. And that's one of those things we have to think globally. And I think too many people are looking at this through such a narrow lens that it becomes very difficult to argue that even these big, massively valuable tech platforms, however dominant, have a monopoly. I just don't think that's going to be an argument they'll be able to make.
So I think there's two things we can comment on here. First of all, is Congress does not understand big tech. They're low-level public relations assistants should be sitting next to them, because those hearings were embarrassing. They fully did not. I hate to say, it's like my mom, who is on Facebook more than anybody and who was watching the show, when I realized on her phone she was looking, I apologize, Mom, for sharing this, that she was looking at Facebook on a web browser, not the app. Like it's that, and look, my mother's in her 70s. Like that's fine. She's very technically savvy for someone her age. The second piece I want to point out here, if we're mentioning TikTok, you can of course follow Matt's dance move. That's at Lady Gaga fan South Florida on TikTok. No, that's a joke. Matt, I'm feeling very silly today. I had a social night last night. I was out with a buddy for the first time in like, I don't know, like 8 months. Spent the evening at Gloria Estefan's restaurant, which is a very bizarre socially distanced experience, which I mentioned a little bit at the top of the show. But that being said, Matt, do you think we're going to see some breakups here?
Well, I don't know. I don't know. I guess is the quick answer. I know that's not like a great hot take. We'll
be back.
Right. Well, I guess like it's just everything is written with this hindsight bias, right? Like what's brought up a lot in all of this is like Facebook's acquisition of Instagram. When Facebook bought Instagram for $1 billion, Instagram wasn't making any revenue to speak of. And for years, and I say this as a Facebook shareholder, like almost since its IPO, like for years, like all I heard was you can't invest in Facebook. They don't know how to allocate capital. They spent $1 billion for Instagram. And now that might be one of the best acquisitions like of all time. You know, it certainly ranks up there.
Right up there with Alphabet and YouTube.
So to look back on this with this hindsight bias of what happened after a deal was already passed and approved by regulators almost a decade ago, I really just think like, you know, hindsight is 2020, but to say like Facebook doesn't have competition because it also has Instagram or WhatsApp, or Amazon doesn't have competition because it's so big, or whatever you want to do. Like, I just think that is not, I just think these are very hindsight colored glasses that some regulators are looking through.
And let me give you another example in sort of the opposite direction. Do you remember how brilliant everyone thought the Twitter purchase of Periscope was? Now, some of you are probably watching this show on Twitter, which is technically through Periscope. You know what happens in a couple of weeks? Periscope closes and goes away. So like when companies are making these little bets, like Apple probably bought 10 $300 million companies in the last year that you've never heard of. What if one of those companies turns out to have like transformative technology? Or like, what if tomorrow, what if Google bought BlackBerry so they could compete better with Apple in connected cars? Is that, how do you judge that? Like, I think a monopoly has to be like the electric company. Like, you have no choice other than that. But I do think this is going to be politicized. And Steve, let me throw one more to you. Is this going to set the bar higher for mergers?
I think it'll set the bar. I mean, if it becomes law, obviously it would. You know, it would make them more difficult to complete by putting the burden on companies to prove that it won't harm competition, which fine. But I think they're going to have a heck of a time preventing them. And my worry, though, is that whether or not it's right, we're going to see the politicization of the whole process. And we may see decisions made that don't necessarily equate to what the law intended. And you know, again, I think it comes down to a lack of understanding about how big tech works. And, you know, the other example was the senator asking Zuckerberg how they could possibly make money if they plan to stay free all the time. He's implying that Facebook is eventually just going to charge everybody. And he, you know, this senator, we run ads, and people in the background laughing, like, and he's trying to keep a straight face. And but again, that's exactly what I'm worried is going to happen, is that we're going to have this legislation passed with a lack of understanding. And that's part of the reason that Zuckerberg at the time and other tech executives said, we will help you craft this legislation. We're all for it. But of course, there's skepticism that they're going to do it with a self-serving bias. And that's part of the problem is that we need to get past the idea that big tech is out to get us. And you know, I really don't think they are, because you know, we've seen what happens to big tech platforms when they make decisions that aren't necessarily in the public's best interests. And you know, we're not going to name any names here because we don't want to get political, but that sort of thing happens, and it doesn't take much, you know, for a platform to come crashing down if they violate the public's trust.
I've said this many times before. I believe the tech industry has to do a better job regulating itself. I've talked a lot about this, that there needs to be a tech OSHA. So we're going to take your questions and comments. Wherever you're watching this, in theory, if you add a comment, we can see it. We will try to get to it. But Matt, you wrote the last question. So I have a feeling you had something you wanted to say here. Will these rules, if they, whatever happens, will this be a net positive or a net negative for society?
Well, so here it goes. All right. And you guys have already made some great points and stolen some thunder here. We didn't talk about this beforehand, like how we felt about this law. But look, I just have serious doubts if the overall effects of this bill is going to be a net benefit for consumers. Look, it doesn't mean I disagree with all of the provisions. For example, I think I like the added whistleblower protections and incentives. But what bothers me the most about this is that our political system, and I think politicians from both parties are to blame, have come to equate being big with being bad. And I just don't think that's true. I suppose these companies can make for popular punching bags, but for the most part, these companies, and I'm talking about the usual suspects from big tech, have added much more value to consumers than taken away. And I know that's not a popular opinion right now, and I'm not saying these companies are perfect and don't deserve any scrutiny, but I think I stand by that. Like, so let's take Amazon. And I'm echoing some good points made earlier today by Marcelo Lima on Twitter, who we follow and is like a great SaaS investor based out of Miami. And he said he heard some pundits compare Jeff Bezos to a robber baron. And that's just horribly inaccurate. Robber barons made money by squeezing profits from scarcity. They had monopolies. They raised prices because they controlled finite resources. Bezos has done the exact opposite. He's brought abundance and lower prices. On the retail side, he's created a marketplace that has launched the fortunes of millions of merchants, all competing to offer better products at lower prices. And he's poured billions of dollars, foregoing profits along the way for years, so that delivery options through e-commerce are now a viable option for consumers. Your margin is my opportunity, right? That's what he famously said. Do you think Walmart and Target and other companies would have poured nearly the same amount of resources into delivery and logistics if it hadn't been for Bezos paving the way? No way. And this has caused measurable deflation at a macro level. By pioneering cloud computing technology with AWS, Bezos started a revolution by offering massive computing power at affordable monthly prices. And this has also contributed to a net deflationary environment and has spurred a huge increase in innovation, company formation, and entrepreneurship.
So Matt, let me jump in here, because I had a conversation last night with my younger friend, and I was explaining the internet boom of the 90s and how it had to pop because there was no way to make money. And the reason there was no way to make money is the cost of the hardware, of the physical servers, was absolutely more than you can make in advertising. So like the company I worked for at the time, Uproar.com, which was a top 25 game show site, we did a deal with Ford. We're going to talk about Ford earnings a little bit later, where we turned Bingo, the game Bingo, into Focus to launch the Ford Focus. And it was something like a $50,000 ad contract that cost us $80,000 to implement. Now, because of cloud technology, if you have a little website that blows up, all you have to do is like up your account a little bit and maybe get Cloudflare, maybe get a couple of other things that might cost you like $60 and incremental costs. So any company like you and I tomorrow could launch a website if somehow like I don't know, like an hour later, Beyonce retweets us and a million people are there. We could be a viable business. That's democratized everything. And you look at Facebook.
Correct.
I spoke last night on Facebook Messenger with friends in 4 countries. Like that wasn't a thing you could do like previous to all of these apps. Like phones weren't connected that way. Like so, and then Amazon. I live 0.4 of a mile from Target. I literally can walk to Target. I do almost every morning. I'm in Orlando now, but normally when I'm in West Palm Beach, I can walk to Target, and oftentimes at like 7 o'clock at night, I'll just order from Amazon because Amazon will say you'll have it tomorrow. Like the amount of convenience, and what does that force Target to do? Be really price competitive. They had to buy shipped to have same day delivery. This is an arms race that benefits consumers. Let's take
Absolutely. And Dan, just real quick. So like when I was in the Navy, like I was dating my now wife, she was my fiance then. And I probably spent a car payment on long distance bills every single month. And now, like for that, if that same scenario was to play out, it would be free to communicate on the like WhatsApp or Facebook Messenger or just Facebook. I mean, like, so these things I feel like often we just focus on the negatives and not the positives they have brought to society.
Yeah, absolutely. And it's also forced innovation, which is going to bring up a question from Max Lucas. I think companies not being able to be acquired might hurt innovation. How many startups have acquisition as their end game? Some might not get started if they have to do it alone forever. I'm going to jump in quickly here, and then I'll let Matt and Steve weigh in. I don't think the average company that's starting with that goal is the target of this, because no one is going to care about Facebook or Amazon or Apple buying $300 million, $500 million companies where, you'll see this, like Apple has bought a company that like is working on a tiny little part of podcasting, like, and they're getting rid of their product, but they just wanted those 30 employees. So they paid like $200 million. Steve, your thoughts on this? Do you think this is going to hurt startups?
No, I don't think it will. I think the vast majority of startups aren't getting started with the goal of being acquired, because that sort of, for me, likens. I think of how I invest. I never include acquisition as part of my thesis, and I think in order to actually generate or build a decent company, you have to have that long-term vision in mind. And oftentimes that leads to acquisitions, which, however annoying as an investor, when you spend a lot of time researching a company, only had to have it get acquired for 30% when you were looking for a 20 bagger. That's I think part of the challenge. But there's potentially an argument, and I'm sure there are cases where this company was built with the vision of eventually getting acquired, but I don't think anyone can realistically bet on that.
So
as the
disagree.
person, Matt, let me jump in here.
Yeah.
As the person who definitively wrote Amazon will buy Radio Shack, I don't think I get to comment here.
Do disagree, Matt. I'd love to hear you.
Yeah, no, so I actually disagree. I'm not saying as an investor you should ever make an investment with an acquisition being your end game. However, if you take away the possibility of acquisitions from big companies, they will have no choice but to like start up internal programs to compete with these smaller startups.
Right.
And and often acquisitions are like just a better option for them. And so now, like, if they're forced to make internal programs, they might recruit away your best employees or programmers from startups. I don't know. I just think I think there's unintended consequences that have, believe it or not, that have not been thought through with a potential bill like this.
Yeah, and I agree with that. I'm thinking of it more from a small company acquiree's perspective. But yes, I think it could definitely stifle innovation for those smaller companies. But often is the best value for a big old conglomerate to swallow up a company that already has the technology they seek.
So you're watching Seven Investing now, and I don't know if Google's watching. I don't know who in the Amazon, Facebook leadership. We're, of course, an independent company. But if you want to throw $400 or $500 million our way, we will take it under advisement.
Think about it.
Probably we won't do it. That's how excited I am, guys, about where we're going. So
speak for yourself, Dan.
We just started talking about that our 1 year anniversary is going to come up, and we're going to do a show to celebrate the 1 year anniversary with all of us. We're going to put on suits. We're going to do the whole thing super fancy. But in this year, what have we done? Steve, you've been there. Matt, you've been there since the beginning. Steve, what's our core mission? What are we doing for our members?
We provide, I guess, the core piece of our service is we provide 7 stock recommendations every single month to our members who pay us $17 per month or $170 per year. We also have a referral program for existing subscribers to earn free months. But that's the core of it, really, is that we take a lot of the legwork out for you in providing comprehensive reports and recommendations on 7 stocks every single month. And we also talk monthly with subscribers about stocks existing on our scorecard that we still like. And so anyone who's interested in joining can go to seveninvesting.com/subscribe. And it's just been a fantastic ride so far. And we are so thankful for the support of our early subscribers. I can't wait to see what we do in the year ahead.
So I was one of those early subscribers, but I think the best part of this, and I think you see it on a show like this, we're all loose and having a little bit of fun, is there's 7 of us, 6 at the moment, but normally there's 7 advisors. There's Sam Bailey, our marketing lead. And that's kind of the whole conversation. And what happens all day is we're not isolated in a bubble. We're throwing out news stories. We're throwing out, oh my God, did you see this? Why is this happening? What's going on? And the level that like my personal or Steve's or Matt's research gets amplified is so deep, because I might say like, here's a company I'm looking at, and Matt might have a question that I've never thought of. That's not our work. That's just kind of who we are. Like Matt and I have dinner like once a month, and we'll be throwing out companies nobody's ever heard of, going like, what's going on here? So like what we do in fun is what we do with our members. It's what we do like, Matt, this is basically just continuing our conversation, right? Like that's
absolutely
how it works.
No. We look. What I can say is like the six of us love investing, and it's like what we always talk about in businesses and business strategies. We just geek out on it, and we love that and appreciate so much our members who make it possible for us to do this.
We cannot thank you enough. We would like your questions. We would like your comments. All the questions left over from Wednesday's show, we're going to do at some point next week. So multiple times on Wednesday's show, I said, we'll get to it on Wednesday or Friday, because mentally I thought it was Monday's show. It was not, it was Wednesday. So at some point, we're going to get Max, we're going to get Manisha on. We will get to your biotech questions. We got a busy show here today. We're going to get to what you're watching. But Robert G. Cart says, Matt is fired up. I love it. Yeah, absolutely. And Jay Naranje, he wants to know, Matt, what is that behind you? You have a new background.
Yeah, so it's actually a Morningstar big chart. I think that's what it's called, or the big picture. And what it shows is like the price action of equities and other assets classes going back like 100 years. And it just shows you like when the Great Depression happened and other things happened, like the Vietnam War or whatever, and like how like what must have seemed like such a huge dip at the time is only a little blip in the long run, and it helps you keep perspective. Like the long term is what is important when you're investing, not the short term.
I love how other people put up Starry Night. Matt throws up a Morningstar big chart.
And though it may not seem like it, Matt and I were not there for the Great Depression. So before we do what we're watching, Matt is going to talk PayPal earnings, and I'm curious about this only because PayPal and Square are somewhat competitors. And I had a little bit of work done at the house today. I had some screens blow down in my screen room here, and I had a contractor come, and I paid for it in advance through Home Advisor, but he had to go out and buy some products. So he slipped the receipt under the door, and he said, I'm on Cash App. And I'm like, I'm not. Like, what is Cash App? I knew what it was because I do this for a living. 90 seconds later, I was registered with Cash App.
Yeah.
That scares me with PayPal sort of not. It's less of a go-to for me, but of course I'm a big Venmo user. So Matt, how did PayPal do?
I actually, for PayPal and Square, but like for PayPal, like few companies have fared better during the pandemic than PayPal. This year, they just reported their fourth quarter and full year earnings this week. For the full year, they added 73 million accounts. They now have 377 million active accounts. That's the most accounts they have ever added into the year. For the full year, revenue was up 21%. Adjusted earnings per share was up 31%. And they produced $5 billion in free cash flow. That was almost a quarter of their revenue. Venmo, Dan, you said you use Venmo.
I use Venmo all the time.
They now have almost 70 million users. The total payment volume for Venmo was up 60%. That's all the dollars facilitated through Venmo for any transfer or purchase that was made using that platform. And just as important, engagement continues to rise. Daily active users was up 29% year over year. And they averaged, for the active account, they averaged 41 transactions, which was smaller growth than I first expected, to be honest. But once you adjust for new users who use the platform less than users who have been on it for a while, and the Honey acquisition last year, and obviously a significant decline in the use for travel, it wasn't that bad as it looked at first glance.
Matt, does this like allay your fears about dilution? Because one of my concerns about PayPal Venmo is, well, I also I pay my rent using Zelle. Now I apparently use Cash App. And what used to be like one payment, now you have to have like 4 or 5. But it does seem like that's just taking share away from like you go to a store and you get out cash or your credit card. So do you see this as like growth for everybody?
Yeah. So I mean, like I would say, like overall, like you still want to like it's still like a few years ago, Dan, you were paying a check for your rent, or you were using a check to pay for when your handyman came instead of Cash App. So I mean, like cash and check is really like the quote unquote boogeyman here. I mean, that's who it's taking share away from the most. And these other platforms, yes, there's going to be more than one winner in this space. Like, don't invest in this space thinking there's only going to be one winner, but there can be many, many winners, and with the ultimate losers kind of being cash and checks.
We live in Florida. I've been in line in the grocery store, and people trying to pay with checks is common. I've seen people trying to barter. Like, like a guy with like a stack of animal pelts, like trying to, that's how old some of the people are here. So Matt, you had a couple of areas that you were a little bit excited about for PayPal, and it's buy now, pay later, cryptocurrency, and sort of more bank-like functions. Why don't you talk about this a little bit?
Sure. So first of all, buy now, pay later. So they just launched that late last year, and the management said it was the fastest start to any product the company has ever launched. 3 million customers used it for $750 million of total payment volume. More importantly, the 3 million customers who used it, they used it again 40% at a 40% repeat rate. So this, you have companies like Afterpay and Affirm that just specialize in this. PayPal just launched a product like this last year, and it's already being used by 3 million consumers. And that's just like a couple months old. Cryptocurrency. So customers who use PayPal to purchase cryptocurrencies, again, this is just launched in the last few months, were logging in their PayPal account at 2 times the rate than they did before they purchased crypto. And this is going to be rolling out to Venmo users in the first half of this year. And soon, PayPal accounts will have the option of using their cryptocurrencies as a funding source for purchases at any of the 29 million merchants that accept PayPal. That's a big deal. Yes, and they have introduced more bank-like functions during the pandemic. That includes things like direct deposit and bill pay. And also, not to be overlooked, Dan, is the in-store use of PayPal, which is through their credit cards on Venmo and PayPal and QR codes. That's now accepted at 600,000 retail locations, including CVS, Nike, Foot Locker, Five Below, Macy's. And 10 million accounts have used these features for about $20 billion in total payment volume.
QR codes is really exciting to me because I wear an Apple Watch and I can be out and about, no wallet on me, and I can go to Starbucks and I can pay via QR code. If I could check out at the grocery store or Target, that would save me once a month when I've gotten into the car, driven to the store, and realized I don't have my wallet. Like that happens more than you would imagine, especially now that I live in a house that's 3 floors. We're going to talk about forward earnings. Then we are going to play 4 questions about investing. I've planned this segment like a month ago. We are finally getting to it, but we of course would also like your questions and comments. Steve, I'm amazed that Ford sold any cars. We are in a pandemic. Why would you buy a car?
So
go ahead. The Ford numbers weren't terrible.
They weren't awful, and I won't get too deep into the numbers, but there's some takeaways from it. They released earnings yesterday after the market closed. Shares are soaring 1% right now, which is great to watch when you see the headlines come out. Ford shares rise. It's like, really? But it pretty handily exceeded bottom line expectations. It managed to turn adjusted earnings of 34 cents per share. Most analysts were looking for an adjusted loss of 7 cents per share. Revenue actually fell short by about 700 million. It came in at about 33.2 billion for the quarter, which is just a lot of vehicles sold. But a few noteworthy items. They confirmed earlier reports that they have to cut shifts at their Michigan and Missouri plants that produce the F-150 pickup line, and that's a bread and butter segment. That's a big deal for Ford, and it's going to reduce their profit significantly. There's some
is that due to lack of demand?
No, it's a semiconductor chip shortage. Now, that's the big problem is that there's not, it's not a lack of demand. It's interesting on a couple fronts. It's both as it pertains to how this hurts Ford and other automakers, because they're not the only one suffering from this. The average vehicle, I think, has between 50 and 150 chips in it right now. And, they control everything from, power steering to the assisted driver assistance programs that they have built in. And this is really interesting because it's going to hurt production quite a bit. There's estimates that say this could decrease their output by about 20%. And really that gives some of your up and comers like Tesla a chance to just play more catch up. But this isn't really entirely new. It's kind of across the board. Everybody's suffering from the semiconductor chip shortage. So I think what's going to be really interesting is just to watch how much this hurts their profits in the coming quarters. They said that it's, Ford executives are calling it a very dynamic situation, and that they expect to see shortages for at least the first half of the year. The big thing that caused it was that demand for auto sales actually surged pretty hard, faster than the semiconductor companies expected. So they are the ones struggling to keep up with demand. So Ford otherwise would be able to handle this. There's so many chips in vehicles today that they can't produce them without those chips, given the semiconductor shortage. So something to watch for investors for sure. One other thing before we move on, though, is that Ford also announced kind of a GM-esque initiative to invest $29 billion in the next 4 years. So by 2025 in electric vehicles and autonomous vehicles. GM announced a similar plan to invest $27 billion over the next few years to that end. So this is going to be an interesting little arms race between the legacy automakers and up and comers like Lucid and Tesla and NIO. So it's going to be a crazy next few years as we see them pour tens of billions of dollars into electric vehicles and autonomous technology. But yeah.
Steve, not to correct you, but Matt actually has a garage full of semiconductors. He's played the market perfectly. So Ford, no, just kidding.
He's like the guy buying hand sanitizer and then he can't sell them on Amazon because he's jacking up the price, right? I got semiconductors for you. Yeah.
So Robert Cart asks, when does the car market become saturated with too many cars? Every day it seems like a new electric vehicle is coming to market.
Right.
I don't really feel that. Like, I feel like there's really a lot of room for niche players and a lot of space. Like, how about the company that sells me like a $15,000 electric vehicle? Like, that hasn't been invented yet, but I feel like it's coming. Steve, your thoughts here?
Well, yeah, Tesla's actually looking at producing a $25,000 electric vehicle in the coming years. And that's the whole goal, is to make them more accessible. And I mean, I feel like someone needs to make a meme. Every day a new EV comes to market, an internal combustion vehicle dies. Like that's, we've got companies like Copart, that are consistently recycling and salvaging. And it's sort of this interesting cycle, when you have an industry that's selling, in America, 15 million vehicles a year. Those old vehicles come off the road and they're replaced with new ones. It's sort of the life cycle in the automotive market. So I don't think we're talking about saturation. What should be more interesting, though, is as electric vehicles begin to last longer. So you got Tesla working on the so-called million-mile battery, and as they continue to improve their operations and build vehicles that last longer. That's going to be really interesting to watch. And as those vehicles, they don't require the maintenance that traditional, gas and diesel vehicles require. So that's something that I think could really change how we think about buying, owning, and maintaining vehicles. There's no oil changes. There's nothing like that. No gas. It's going to be an interesting decade, I think, as they really pour money into this technology.
So Steve, Matt has a question for Steve. We'll go to that in a second. I will just say, as investors, don't chase EV companies. I think it's really important. There's a lot of people that be like, this company makes like a piece of the horn for Tesla. Like, should I invest? You're overthinking it. Like, I'm not saying there aren't plays like that work, but there's so many. I don't want to call them frauds, but just like they're going to get squeezed businesses. Like the part suppliers, you can always have someone else build parts. We've seen it with Apple. They can take their chip production internal. Be really careful about chasing like these sort of ancillary plays and startups that throw in the word EV. Like if I was launching a restaurant, I'd probably call it EV Kitchen, just hoping like I could get some investment money. Be really careful with that. Matt, you have a question for Steve.
Steve, how long do you think until the majority of vehicles on U.S. roadways are electric and not ICE?
I wouldn't be surprised if that happens within 15 years. And there's a lot of people buying new ICE vehicles, internal combustion engines, for anyone not familiar with the acronym. And with as much money as they're pouring into EVs, and as the industry goes that direction, I think we're going to have a lot of vehicles on the road purchased today that are beginning to really get retired in the next 10 to 15. And I think that's kind of when we see the shift. And that's an off the cuff answer, of course. But we have other vehicles that are coming out, so it's going to be a pretty crowded market. Apple, the whole Apple deal announced just yesterday, right? With Apple striking, or in talks rather, with Kia to make an Apple branded electric vehicle. So that should be an interesting thing to watch. But yeah, that's go ahead, Dan.
Steve, let me ask a sort of related question. So right now, I drove from West Palm Beach to Orlando. Mm-hmm. I stop at a rest stop very quickly. I don't need to get gas. I can make that trip on one tank of gas. So everything is based on convenience. I'm going to grab a cup of coffee. I'm going to go to the bathroom. I'm going to get back in my car. I'm going to go. When we move to electric vehicle charging, and it takes 30 minutes or 15, 20 minutes to recharge your car, depending on what you have, are we going to see a wholesale change in convenience stores moving to more of like a Starbucks cafe model? I know 7-Eleven has been testing this model. Or is charging going to get so much better that the current model will work?
I think we'll see a combination of the two. I think in the near term, as more charging stations are out there, we're going to have, people just hang around for a few minutes. It takes a few minutes to gas up. But if it takes, 30, 40 minutes at a supercharger to get a 75% charge, I think we're going to look back 10, 15 years ago. Remember how long it used to take to charge electric vehicles? And that's sort of the thing. It's, when people look at, it takes forever to charge, but look at the exponential increase in computing power, for example, that we have, in a cell phone, just the absurd computing power, that is worlds better than the first desktop computer I had when I was a kid. And, I think we have a similar curve when it comes to electric vehicle charging technology and battery tech in general. So a lot can happen in 15 years. I think, how old is Facebook? 14? 17, something like that. I mean,
less than 20. It's less than 20.
Bonkers to think that when I'm graduating high school is when Google's founded. Like, really? Yeah. So that's something that is incredible to think, what can happen in 15 years. We're talking about electric vehicle tech. I think it's going to be wild.
At my first job, I had the single internet account for the company, and it involved putting the phone on the modem cradle, and no one could make a call out while our writers were sending in stories. So I believe we had a CompuServe account. So this goes way back. We're going to move on. We're in the home stretch here. You may have noticed we are making these shows a little bit longer, and we're doing that for a reason we can't tell you about yet, but there is something really big coming for distribution of 7 Investing Now that we are really excited about. So tell your friends, follow us on YouTube. Certainly make sure you're following @7investing on Twitter. There's a lot of great stuff shared there. That's sort of a portal to all of us because we tend to retweet from the main account a lot of the stuff we're doing. And we're all pretty good Twitter follows. But there is something really exciting coming for this show. You want to be there when we tell you. But let's get to 4 questions on investing. So these are 4 questions I wanted you guys to answer.
Here we go.
First one, and I'll let Matt start, is have you ever invested in a company when your research told you it was probably a bad idea?
Oh, man. Well, so yes, but I'm trying to think of a good specific example to share. But what I'll say is that most commonly for me is I'll invest in a company when I think the valuation is outrageous, but a small position. If I don't think, I think that's would be the best answer I can give. There's lots of times where I'm I love the company, but hate the valuation of the stock, but I'll still take a small position because I love the company so much. I cannot think of a time when I specifically did not like the company, but still bought the stock.
Steve, your answer, the same question.
Yeah, I think that's a qualitative question where I've never invested in a company where I was this could be a big winner, but I really hate the company. No, I won't even touch it, right? And I don't mind missing, companies that ended up being big winners that way. Valuation concerns were something that always plagued me when I was younger. and less so these days, because too many times I've seen the abilities for companies to not only grow into their valuation, but command even more seemingly absurd multiples. And part of that is just looking at how companies like Amazon, which for the first 20 years of its existence scarcely turned a profit, but rather, took all of its cash flow and maximized it and reinvested in growing its enterprise value. And I think I really underestimated the power of that compounding capital allocation decision by reinvesting your cash flow when I was younger. So no, I haven't done it when I really hated the company, but I have done it when I'm like, oh, it's expensive. And that's just a regret that I think we all have, and one that I'm less prone to now.
So I almost did it, and it's kind of hysterical because about 18 months ago, I did a podcast with two mutual friends of ours, and they made a compelling case for GameStop. Not GameStop to go up 8,000%, but they basically made the case that they were financially well run. They had very flexible leases. They were shrinking to profitability, and that they could pivot their business. So it was like a 5-10 year GameStop bull case. And I didn't believe any of it, but I trusted the two people who were talking so much. I came really close to buying a little bit on the idea of like, maybe I'm wrong. Had I done that, I would have dumb luck made a bunch of money, which of course I would have sold instantly. But I was
really hoping that story was going to end, and I sold a lot of it this month, and I'm going to retire early. But you all are invited on my private island.
Dan's not allowed to retire early. We want him to remain our host.
Definitely want him, but
here's the thing.
I would have been very happy for you, Dan, if that was how the story ended.
Had that happened and I had bought it, I'd be talking about here how that's not how the stock market works. Like my friend's thesis wasn't that there'd be a short squeeze, and we're seeing a lot of data that it wasn't really retail investors. It was institutional investors piling in. That's sort of like a once every 2 years scenario. It does happen, but you can buy a company for the right reasons. And one of the reasons you sell is if something crazy happens and it exceeds your expectation, and you go like, geez, I thought this was going to go up 1,000% in 10 years. It's gone up 1,000% in an hour. That's a reason you can get out. You can sell. We're not big fans of selling. I've sold one stock, that's WWE, in the last 6 years. So, and that was for moral reasons. As I've talked about many times, it was not for belief in the company reasons. I actually believe in the company quite a bit. Okay, let's move to question number 2. What's your biggest investing regret? And you can't say not buying GameStop 2 weeks ago. Steve, I'll let you go first here.
That I didn't start earlier and put more money to work when I was a whole lot younger. I didn't have much of an interest in investing when I was in high school, but I see kids investing now, and I'm actually getting starting custodial accounts for my 13 and 10-year-olds. I struck a deal with them. I talked about on Twitter where for every book they read, it's got to be a legit book. It's not like comic book or something. But for every book they read, I'm going to give them $2 and throw it in a custodial brokerage account. And they'll probably throw their allowance in there too, and they can learn about investing when they're really young. And hey, Warren Buffett bought his first stock when he's 11 years old, and I'd love to see my now 10 and 13-year-olds really learn about investing when they're very young. And I'd say that'd be maybe my biggest regret. And maybe not buying a little company called Netflix could be another one. Back in 2006, I had I think it was like $3,000, and I was thinking about buying Netflix, and it was like $271 a share. And but that also raises the question of, would I have held on? Probably not.
And you would have hit the whole Quickster debacle. Maybe you would have sold out. But that being said, we're going to throw this to Matt. Steve, if you want to get up, your dog is being very polite in the background. I know he wants to get in to see the kids in the other room, so you're welcome to let him in. Matt, your biggest investing regret?
Well, the right answer is Steve's, like not starting early enough, but that's not really that fun. So I'll give you another one. Like Trade Desk. I bought the Trade Desk when it was, I'm going to get the dates wrong. I don't have it in front of me. I've written about this before and tweeted about it, but I bought the Trade Desk, I don't know, like in the high 40s, and believed in the long-term potential of the company. And for about 6 months, it did nothing. I wanted to buy something else, but I didn't have any cash at the moment. I was frustrated with Trade Desk that I hadn't done anything for 6 months, and I sold. And literally within a month, I sold it. It had like a great earnings report, and it exploded upward, and it's done nothing but go up ever since. I don't even want to know what the price is of now, but I think I missed out on a 10-bagger in the last couple of years. Oh my, like maybe a 20-bagger. I don't know. But like, But yeah, so that's like, besides not starting early enough, I'm looking at the price. I think I missed out on a 20 bagger because I sold it at a loss. And somehow, if you look at the long-term chart of the trade desk, you'll be like, how could anyone buy and sell on this chart and come out at a loss? I did it.
I apologize for laughing at your misfortune, Matt. But I know you've written about it before, and yeah, that's a good story. You're one of very few people who's managed to lose money.
I'm an elite investor. Okay,
you've made it up with some of your exceptional.
You're the Atlanta Falcons of investing. Like you can turn 28-3 and somehow not win the game.
That's really what it was.
Doris and Renee Carell said, good idea, Steve. Kids are never too young to learn. So my son just turned 17 a couple of days ago. And I've talked about this before, that he's going to work this summer, hopefully. They have a really short summer because they started school late. So hopefully he can get a job. And I'm going to have him put half the money he makes into an investing account that I'll let him help direct. We'll look at companies he likes and, company, maybe Netflix, maybe Disney, whatever it is. But part of that isn't just investing. It's because I asked him, what do I do for a living? And he said, well, you're kind of famous and you sit on the couch with a computer. So I kind of want him to understand the stock market a little bit. So he understands that, like, I'm not famous-ish because I'm funny on Twitter. But like when someone freaks out seeing at Target, which like happens like every now and then, that it's actually because I'm putting a lot of work in. It's not like because like, I don't know what he thinks I'm doing when I'm broadcasting, but we're going to teach a little bit of that. Let's go to the third question here. We've got 4. Have you ever invested in a company whose ethics you question? Matt, you can take this one first.
Wow. So let me tell you a story. Okay. So actually I bought a Wirecard last year. This is a payment processing company. Its numbers looked really good. It looked reasonable. It was decent growth. It was a European-based company, and it was growing strongly in Asia. And there were some articles out about it that made it question like its accounting. So I invested in it, and the CEO had responded to the charges, and then I kept reading back the articles, and thankfully I got out at a very small loss. It was just too much of a battleground for me. At the end of the day, I really didn't know who to trust. Like these articles that were coming out, I want to say it was in the Financial Times, but there were some reporters in the Financial Times that were just really hammering this company. But then they would do an audit with like these big companies like Deloitte or whoever, and the audits would come back clean. So I didn't know who to believe. Eventually it was too much for me and I got out, and thank goodness I did. Within like 6 months after getting out, the whole company basically imploded. It's like a penny stock now, about to go bankrupt. So like it's generally a good rule of thumb to stay away from companies where you ever mistrust management to that extent. But as far as like sin stocks go, like as far as like tobacco or alcohol or social media or what defense stocks, like as far as like if you think a stock is not quote unquote good for society, no, I have no qualms about investing in sin stocks. But stocks where you don't trust the management, stay away. See,
the problem there, Matt, is their auditor was a guy named Deloitte. Like they fooled everybody. That was one, and I'll go back to Luckin Coffee. And we've talked about this a lot, that I was not bullish on the business model of Luckin Coffee, while many of the people in our investing sphere was. That was legitimate. Nobody knew that Wirecard had billions of dollars in fraud in their books. Nobody knew that Luckin Coffee was misstating sales. All we can do as investors is interpret the information we're given. And if they're large companies where the audit reports are clean, you kind of have to accept those results. So every now and then there's going to be fraud or a company that's right, misstated something in a way that materially changes their results. Steve, do you invest in companies that you have moral issues with?
No. That I will clarify. I've never invested in a company that beforehand I knew of potential moral conflicts with my personal moral compass. And I guess I have been invested in companies that later on had issues crop up and I sold them. And I won't name names, because I don't, want to really get into that whole debate. But there are companies that, I realized that the culture was less than savory, or there were some issues that cropped up later. And I said, you know what, I really don't like this and I can't support it. And I will sell that. And I have no qualms with doing that, even if I'm potentially compelled by the business. But I pulled up our 7 investing principles page. There's a 7 principles that kind of guide our investing decisions. And our second principle is to buy companies, not tickers. And you have to think of it as owning a piece of a business. And one of the things that we write on that page is that every time we make a recommendation, this is a quote, we also consider it as becoming a partial owner of a business. We want to invest in good companies that are run by people we also consider to be good company. And that's it's one of the things that really guides our investing. And we want to trust, like Matt said, we want to trust management. And if I have moral conflicts with the way management thinks, then I will seriously consider, and most often cut that from my portfolio, because I don't want to have to worry about that.
To me, there are so many companies in the gray area, companies I love like Amazon, that hasn't done a great job by its warehouse workers. But one of the ways I judge it is, are they working to make changes? Now, sometimes, like Walmart was kind of forced to make changes because the economy changed and they had to pay people more. But if there's sort of like some effort to address what's wrong, these are really, really large companies. There's always going to be something a little wrong, but I don't buy like tobacco companies. On the other hand, I'd invest in liquor companies because that's more of a chosen vice for me. So it's a little bit tricky. And I know that some people, and I don't disagree with this, if they identify sort of a sin stock that they can make money in, their attitude is, I'll make that money and I will take some of my personal money and I will do good. So it's not as cut and dry. But we're going to go to the 4th question here because I want to finish up by 1 o'clock. The goal is an hour. It's not longer than an hour. It's, what's something you hear a lot about investing that's entirely wrong? This is my favorite question. And I'm going to start by saying, Jim Cramer, stop telling people to take their profits. Advise them to buy good companies, not make dumb short-term trades. I am throwing down the gauntlet. If you want me to talk about this, I will happily talk about it on air, but it's irresponsible. Steve, your thoughts here.
I had one queued up in my brain that was very similar. The idea, and something that he parrots a lot, is the idea that you should be playing with the house's money, right? To sell just enough to where you sell your cost basis, and the rest is, gains are gains. They're unrealized gains, even if you haven't sold the stock. I don't think that's something that's not the way we should think about things. And on a related note, the idea of first trimming your winners. And maybe it's a little different if you're running a $10 billion hedge fund where all of a sudden one stock is 20% of your portfolio. That might be a little dangerous, but I don't have any qualms with letting my winners run. And if I'm going to sell a stock, I look first at my losers and determine whether maybe the thesis was wrong, or if this is a company I have lower conviction in. And, in some cases, like my March 2020 recommendation that Louis Carruthers mentions here in our comments, I'll re-recommend it because I think it's unjustifiably beaten down. And thank you, Louis. He says his biggest investing regret is reading my March investing pick, liking it a lot and watching it without jumping in. And that happened. And I was happy I re-recommended it in October in time for that rally. But I saw a lot of catalysts that were sort of poised like a coiled spring. But that's I don't like cutting my winners because often they'll run longer and farther than we ever dreamed. And I hate doing that because winners tend to keep on winning.
My longest held position is Microsoft. I bought it during the Windows 8 debacle because I worked there and I believed in the company. I have never sold a single share.
I thought you were going to say you bought it in 83 when you were 50.
Again, he would be on a private island right now.
Matt, your thoughts here.
Well, this won't be a surprise given what we do, but I hate it. I hate it when people say you can't beat the market. You can beat the market. And yes, it takes time, and that might not be for everyone. Some people, if this is sounds like the worst thing ever to you, it is probably better to get an index fund and just set it and forget it. But if you're interested in these things, you can beat the market. It is possible. All 3 of us here are proof of that. Our service is proof of it. And there's lots of more proof you can look around and see. But I hate it when people say that you can't.
That's a good one. Best one, maybe.
Sam Bailey, we are up on the top rope. It is time to hit our finisher. Which company has the most to worry about when it comes to antitrust legislation change? Overwhelmingly, 58% of you think it's Facebook. I think that's probably true. I worry about the weird bias against Amazon. Like Amazon faces a ton of competition, every business it's in, and has constantly lowered prices. But I do feel like there's like a strange like legislative bias. Steve, your thoughts here?
I think when the rubber hits the road and, if they were to make those arguments against Amazon, Amazon could easily prove that it is up against the most competition. Google, I think, I'd say probably Facebook, but maybe a close second is Google, that's already been hit, by it's like every few quarters, it seems like they get hit with another $5 billion antitrust fine in Europe or something. And they write it off as an operating expense in that quarter, like it's nothing, which is incredible. It's usually just a slap on the wrist, but Facebook is close second, Google.
Basically, Google's monopoly part is search. And here's the problem. What are you going to force them to spin off half of the alphabet? Like it just doesn't. Like you can't make people go to Bing. Like it's just not going to happen. Like I think Yahoo still has search. I don't remember if Bing or Google powers it. Nobody's going to DuckDuckGo, no matter how many billboards they buy on the Florida Turnpike. Matt, I'll give you the last word here.
I would answer Facebook too, but what gets very little attention is Apple, I think, could face a lot of antitrust change, like their app store, like the taxes they charge on that, like the fact that they collect billions of dollars from Alphabet to make it the default search engine. Right. I think there's a lot of areas legislators and regulators can look into Apple's business model on the iOS platform and say that's a monopoly or that's an unfair advantage or unfair playing field. So I think Apple could get more attention than people gave credit for in that poll.
It's been a marathon. This is the first time we've ever done a full hour. This was intentional, and it was done because of the secret announcement we have coming. Maybe it's going to be weeks. I'm not sure, but wanted to see if we could do this, wanted to see if it would be fun. I had a great time. So if you'd like to get in touch with us, you can do that at info@7investing.com. Now that's best for questions about our service, questions about, are you thinking about joining? You're having a technical issue. If you want to talk to us and sort of ask us questions, better to hit us at @7investing. And what we're doing with a lot of questions is we're either making them content on this program because we want to answer them for as many people as possible, or we're eventually going to make some of them content on our website with our newly evolving website where we can post more content a little bit more easily. In general, we're not going to share opinions on individual stocks. It's we're a paid research service. So we're giving our best research to the members, but we love when you interact. We also love if you're doing something fun on social media and you want to include us, like you had a poll question, those conversations could be really great. This has been a fun show. Sam Bailey, apologies for my sort of not being clear on the graphic. We're going to have a really exciting new graphic on Monday's show. Thank you for Max Chatsko for putting that together. For Steve Simonton, for Matt Cochran, I am Dan Klein. We'll see you Monday.